Oh, hey, we're on TV. It's freight forecasting Thursday. I'm Michael Vincent, freight forecaster here at FreightWaves, and with me today is Zach Strickland, our director of freight market intelligence. How you doing today, Zach?
Great, Mike. I knew I was going to be on here today. So
you did?
Yeah, I did.
Oh,
I got the memo.
I always get shocked when the camera comes on. It just confuses me. So today we're talking about the recovery, right? A V-shape or reverse square root, I guess. And it could turn out to be something else.
That's the debate, yeah.
But that's kind of, well, debate. I don't know if it's a debate, but it's a discussion. I'm not debating you. You win all the time.
Not true.
Well, I don't want you to win. I don't want to debate you and then lose, and now you've got a winning streak going on. But so, the first thing that I really wanted to do to start off this show is because we're going to be talking about V-shaped recovery or reverse square root recovery, or is really what we're looking at is where are we going to be after we look through July 4th, right? And like John Paul Hempstead, I forget what he called the 4th of July, but basically it's kind of like this obelisk we can't see through.
Yeah, and I get what he was saying there. I mean, basically he's saying, since we've entered this new world order, or whatever you want to call it, the new normal, to use a cliche, what does it look like once we get through this traditional peak season? Well, I think the answer lies in the fact, what I just said, this traditional peak season. We've kind of come back to this, even though I know that April and March and May even were not necessarily what we would consider normal.
Yeah.
We kind of have settled back into a normal peak season. So we have to apply the most recent information as the most valid,
Yeah, that's exactly how I took it too, right? It's been acting very seasonally, really since leading up into Memorial Day.
Yeah.
Right. It was Memorial Day. Labor Day's Memorial Day. Right.
Yeah. We seem to,
but at much higher levels. And by the way, it's a restart economy, so that's why he's saying you really can't look past this, because how are the effects of the restart? Is it what I call industrial preponomics happening right now? Is that affecting it? The PPP, etc. How is that all going to affect what's happening post 4th, because we're kind of looking at that as PPP ends and really the ramp up for what hopefully is a startup of the industrial economy starts to fade away a little bit, the ramp up stuff.
Yeah, and I think, when I was debating Craig Fuller, I kind of cited some of these things as, headwinds to a recovery process. I obviously did not think that they would, I thought they'd be a lot less, or I guess a lot heavier in the earlier phases of the recovery, and they've actually proved to be the opposite. And I think it's not necessarily that the industrial economy was, booming, and it certainly hasn't boomed.
No.
But there's this impact of shifting demand and shifting behavior that we couldn't apply to the model, because you don't know what you don't know to an extent. All we knew is that the industrial economy accounts for this much freight, the consumer economy accounts for this much. When people are unemployed, they traditionally do this. Well, this is not your traditional recession. It's not your traditional industrial recession. It's not your traditional freight market.
It's not?
And we've had to...
I thought we went through a restart of the economy every year.
Yeah, every single year we have to start all over. So,
awesome.
Yes.
Hey, let's jump into this. What I really want to do is kind of just ask you some questions and it just OTVI. Outbound Tender Volume Index. There's been a lot of discussion. We've been going through it as what does it mean? These volumes are really high, but industrial is down. So what does that mean? And so Outbound Tender Volume Index is what it's called. So what is it?
So the Outbound Tender Volume Index, it's basically our proxy for truckload volume in the United States. And that's key, truckload volume in the United States. So this is basically a shipment count type index. So the amount of shipments, et cetera, that are moving through the United States at any given moment in time. It's an index with a base value of 10,000 based on March 1st, 2018. So that just means that's your starting point. An index value of 11,000 indicates 10% higher volume than that starting point on March 1st, 2018. And right now we're sitting around a 12,000 value.
Do the math, 20%.
20% higher.
than the indexed March 1st, 2018.
Yeah.
So exactly what is it measuring? It's electronically tendered loads?
Yes.
Which is predominantly contracted freight.
Predominantly
right?
contracted freight. It does not exclude spot market. There's nothing in there that says this can't go on the spot market.
No, right. Yeah, there's some in there, but it's predominantly.
Most of them have contracted rates that they're tendering in this process. Yeah.
So it's why is it indexed?
It's indexed basically to make sure that it doesn't. Anything that comes into the index doesn't mess with it. We can keep the methodology the same, so that if we got some sort of influx of additional, something fundamentally changed to the data, whereas you had an additional source or something like that,
Gotcha.
you can maintain that index level without overflowing it with new information and making it look like there's a 20% increase because we got new data. No, we can just reset the base on that old data, on the new data set.
Right, got it. That's why it's indexed that way. So it is not altered. Is that not that there's volumes might be up 10% and plus we got 10% more data from a different source. It's been indexed and we adjust that base as we go along.
Right.
So excellent. Thank you so much. So the ATA, showed truckload tonnage down.
Right.
In spite of volumes that we're talking about and outbound tender volumes up.
Right.
So why would that be? Does that make sense to you?
Yeah, no, it absolutely makes sense to me. This is an issue of where we're essentially trying to measure two similar things, but not the exact same things. The ATA has tonnage. So right there alone tells you that this is a different measurement. It's basically like measuring weight or force versus, just a fundamental count of something. And that's what we're doing. We're on our outbound tender volume index, we're measuring shipment counts or load tenders. They're measuring weight. So a truckload can have 10,000 pounds on it. It can have 40,000 pounds on it. And one of the reasons they do this is because they have LTL information in there as well, which you can't mix an LTL shipment with a truckload shipment and call it the same thing.
True.
So
Very true. Yeah.
So you can't just count like the 50 LTL shipments on a truck and the one truckload shipment has the same thing.
Exactly. So it sounds like you're saying it's not a fair comparison, but that's not what you're saying at all.
Right.
You're saying they're really measuring two different things, and both are extremely useful, and in conjunction, they become even more useful.
Yes, absolutely. In conjunction, they're actually extremely useful. And really, the takeaway here is that, even though the tonnage index is useful in its own regard in terms of measuring weight, it has its own bias as well. Like when you're measuring things that are heavier, we used to do this in LTL.
Yeah, absolutely.
You have a heavier weight per shipment and a lighter weight per shipment. It does not translate exactly to you're going to pay two different, they could be the exact same revenue on those shipments.
Absolutely. Right.
And so in this regard, though, I think what we're seeing is just like we were talking about the industrial economy. When you're measuring things in weight and how heavy they are, how heavy things can fit on a truck, denser items fill up a truck in terms of weight faster.
Yeah, you'll weight it out before you cube it out.
That industrial production, that industrial economy
does that.
Yeah. You've got your heavy metals, machinery, equipment, things like that are super heavy. The retail side of things, which has been the part that's been really the quickest to recover here in the last bit, that's your lighter stuff. That's your electronics. That's your medical masks, super light masks, your retail consumer products, things that have a lot of air in the boxes. Toilet paper, of course, is not exactly heavy. So when
it's
you're
in heavy demand, but
when you're measuring those two things together, it's not,
so it makes perfect sense to see tonnage down and volumes climbing.
Correct.
Given the state of where we're at right now, the commodities that are moving, the commodity mix, the freight mix that is generally, near and dear and very important to LTL, we're kind of seeing that play out in truckload right now.
Yeah, you don't have to think about that as much on the truckload side. So I think that's something that people may not be as familiar with, especially when you're talking about, well, it's a truck, so it's moving. I gotta make sure it doesn't go over 42,000 pounds or.
Yeah, well, a lot of times they're not even close to 42,000 pounds. I had an Easter grass customer once, way back in the day, that If you could put 42,000 pounds of Easter grass on a 53-footer, you can't.
Right.
You can't do it. So let's move on to the first slide here. Thank you so much for that, because I wanted to clear that up a little bit with people so they understand exactly what OTVI is and what it's measuring, and why you see these two different things that seem at first to be counterintuitive.
Right.
Tonnage is down, but volumes are up. How is that possible? Well, it's freight mix. It's really that simple. What is moving? So, Cody, if we could bring up the first dashboard here, sonar dashboard. So what I've got here, Zach, kind of talked to this a little bit out, is revenue or volumes are up, revenues are not so up.
Yeah, so, I mean, if you look at it over the last little bit, you've got, this is the chart comparing, our outbound tender volume index, again, measuring, load tenders, truckload count, et cetera. We can see that it's actually starting to show that, it's actually pulling revenues up now. So the last, the driver revenue per week measure that we use from the TCA data source, basically a measure of revenue efficiency for drivers, how well utilized is the equipment at this point in time, because the more revenue on a truck typically translates to higher or lower ORs, I should say, better profitability, et cetera. But you can see that the driver revenue follows the OTVI pretty cleanly for the most part, because more volume indicates the better chance that you're going to have utilization. Your driver's not going to be sitting around as much, et cetera. They're not going to have as much time between loads, and it is pulling it up. But if you were to pull this out all the way back out, you can see that the driver revenues have been going down over the last year or so. And that's simply due to the fact that it's not just about volume when you're talking about revenue. You have to price that freight. I'm overly familiar with.
Yeah. Probably didn't want me to bring that up. Bring back bad memories of pricing freight. Excellent. Yeah, so just wanted to bring that out there, and how quickly and how, I mean, it's absolutely, I got a 14-day moving average on volumes sitting over top of this, right? So you can see exactly how that really pulls that revenue. But it can also be dropping at the same time because of price.
Right.
And would that be affected? So this price that we're looking at here is not necessarily contracted or spot, is it?
It can be both. I mean,
it actually is a mix of both.
It's a total mix, yeah.
Yeah, so this is like true across the board type of thing.
Yeah, depending on the carrier's exposure. I mean, some carriers love to do 50% spot market. Some carriers prefer a lower mix.
Right.
I think over the last year or so, a lot of people have been trying to drive that contracted freight volume into their portfolio of business. Obviously, it's a lot easier said than done a lot of times. And even if you were to be 100% contracted, it is near impossible for you to ignore the spot market because you cannot. The market itself is imbalanced by nature. You have consumer markets and production markets. And if you were to cover the entire country and have one carrier, they would be constantly out of balance.
That's a true statement. They would be. Thank gosh that's not happening right now.
Right.
That's what we need. Who had one carrier for June?
2020.
Yeah, exactly. Here it comes, right? Who had the African dust storm for July? You just won your square. So let me move on here, because let's move on a little bit here. So we're talking about that, and it can volumes absolutely can move and show you that driver, and that was weekly driver per driver per week, which is incredibly important. And that's not the one I wanted to pull up. I want to pull up this one here first, which is okay. So we're looking at outbound tender volumes. This is where we're sitting right now.
Yep.
Outbound tender volumes, and you're looking at we're sitting right here. Obviously, yesterday, 24th, and that's what you're talking about here. And I've got my thing a little bit skewed down, but it's 12,000, which is 20% over that March 1st. But it's also quite high compared to last year. And I can pull in a trend line here and just look at it really quickly, so we can actually see what that is. So you're really 8.7, almost 9%.
Yeah.
Above. That's 2018. That's not last year.
Yeah.
That's 2018, which was anomalously high.
Anomalously high, yes.
Yeah. Did I hurt myself doing that? I felt I pulled something in my brain when I tried to say that. Yeah. So it was extremely high.
Yeah, and I think the value of looking at it this way too, especially when you're talking about what do we do in July. what are we looking for in July is the fact that we can see that this is anomalously high. This is outside of the normal range of what you would have anticipated. So it's almost like this is actually, I played this out in my head a few months ago when I was thinking about how does this look in terms of a recovery. It's like a physics problem to me, because you have this huge surge of freight pushing higher. Then you're going to have, what goes up must come down, right?
I've heard.
Equal and opposite reaction here, pulling it back down faster than it went up, which kind of surprised me a little bit, but it did. It fell faster than it went up.
Yeah, back here in March. You're talking about our spike right back here.
And now we have this bounce. So the way I look at this is
dribble and then about,
it's bounced now, and it's gone down. It went down so hard, so fast, it's knee-jerked back the other direction now. So now we have additional energy available for it to go higher than it did in the previous year. Now, do we know exactly how high? No, but we can anticipate that at some point in time here in the near future, this thing's going to start. It's probably not going to peak out as high as it did back in March, and it's probably going to start to hover and almost orbit around the previous year's OTVIs.
I would tend to agree with that. I mean, when you were looking at this chart here and we're looking at this timeline, okay, they're slightly askew as to when these things occurred. And 2019 had that stronger dip here as you had here. There was tweets happening and so on and so forth. But this dip that's going to happen next week, there's going to be a drop, obviously.
Obviously.
It's going to come down. You're thinking it's going to come down and it's going to continue this, which I would think it would.
And I think it looks like it may stay higher than previous year, or even 2018 throughout July to an extent. But I think August is going to be a month to watch, and it's one of those pivotal months to see just how well, the shippers, and the way I reconcile this, other than just looking at a line on a chart, is you have a lot of supply chain issues right now.
You do.
You've got people. You've got such an uneven and a lot of confusion out there right now, where people are like back in April when the market was bottoming, shippers were canceling all this freight, canceling orders.
Very true.
All of a sudden, even a shock to me, everybody starts ordering stuff. And it's not the same stuff that they ordered back in February, and it may not even be the same stuff they were ordering a year ago, but they're ordering different stuff, causing shippers to now say, wait a minute, I need to get that ship back over here with that freight that I needed, that I canceled in April. Now you have so much freight sitting at ports, in warehouses, shoved in corners of places that they're now having to dig out of in reaction to this unexpected demand. Unexpected demand can have this overheating effect on the market as shippers, or companies just in general, try to manage their inventory. They can't rely on traditional, inventory algorithms telling them, hey, we're going to need this amount of toilet paper.
No, exactly. Yeah, you're exactly right.
Food warehouses, grocery warehouses, they no longer have anything that will predict the demand for their products.
Yeah, it's all out the window.
So now they have to go and order a whole lot of the things that they're seeing, spike in orders.
So is it resiliency ordering, you think it is, to try and...
It's more like, human nature.
Yeah, it's more like human nature.
Human nature. We see something and it's unexpected. It takes us off guard. Fight or flight mechanisms start to kick in, and we now are all in on something because we have to do something. We don't have a timeline to react. We don't know that this season is going to have an end. We don't know that this season is even beginning. But we got to react to what we have right now. And a lot of the shippers out there are now having to recover from this depressed market activity that they thought was going to last for a couple of months. Now it's coming back online.
Interesting.
And during this whole process, you're going to see, I think, in August at least, you're going to see kind of a bottleneck as they've maybe not been able to get some of this freight, some of this inventory and people are going to stop ordering it. I mean, essentially.
Yeah.
They're going to slow down.
If it's not there, they're going to slow down ordering it.
Exactly.
So when we look at you mentioned orders a couple of different times. So we see this volume's going up, and it's acting very seasonal, right? Mm-hmm. So what is supporting this? What is going to support the moves going forward? What are those trends moving forward? So I brought up the orders and industrial production. Okay, I've brought that up, and so what you're seeing. So the orders numbers just came out, so we haven't updated. So it'll be updated by probably tomorrow morning.
Yeah.
Those numbers, but it bounced a little bit. I believe, and it's right here. I think it came up somewhere around this area.
Right.
Is where it came. There's a bounce off of historical lows.
Yep.
It came off of, still way down from last year. These are orders. These are things that aren't moving yet. These are orders from May that'll be moving June and July, et cetera. And if they're orders that are placed that happen to be require manufacturing overseas, you're not going to see this stuff for what, another couple months.
Yeah,
right?
It'll be at least, it's 3 to, it could be 12 months.
Could be, well, yeah, depending on what it is. Yeah. But I mean, it's even a longer gap between seeing these on orders change, and it only came up. It came up off of a historic low. Right. Is what it did. It's just less absolutely terrible. And the same thing with industrial production. It jumped, but it didn't jump anywhere near where it needs to be for us to say, hey, we've got a strong economy.
Right.
Right.
Yeah, and this is a huge warning sign for the future.
I believe it is.
I mean,
I believe it is.
The fact that we are seeing freight volumes recover is great, but a lot of that was already made. That was already produced.
Right.
And a lot of freight movement depends on production cycles. Automotive is a good example of this. A lot of freight moves, before you see the cars. A lot of that freight's moving from Mexico, from Canada, et cetera, and through the United States in the corridor, Midwestern corridors there. But if they're not producing anything, eventually that inventory is going to run out.
It is, and that has happened. I mean, I had my truck serviced last week, and I went, and a lot empty. Last month, record auto sales.
Yeah,
and now they got no inventory.
Yeah, and that's gonna be part of this cycle, this recovery cycle. Is we're gonna see these depleted inventories in certain areas that they weren't prepared for, because before COVID-19. We had an algorithm. Everybody was pretty stable. We were actually on pace to just kind of, we could reasonably predict seasonality and just live on it. Right now, you can't do it because now lifestyles have changed. Behavior patterns have changed.
Yeah.
People aren't going into offices. And there may be another, God forbid, shutdown, in certain areas of the country that we can't foresee right now. That will also create an additional layer of bottleneck.
Yeah, absolutely. Another, whatever it happens to be, wave, whatever you want to call it, but that'll hit it. So I moved on to the next one here, and I've got the tree map up of industrial production by the different sectors or verticals. And so we're looking at this is month over month. Okay, so we're seeing some stuff here. When you first look at this, you're seeing non-metallic minerals, plastic rubbers, non-durable manufacturing up 3.8%, petroleum and coal up 2.1%, durable manufacturing up 5.8%, motor vehicle and parts up 120.8%.
Looks good.
Everything's great. You buy that?
Yeah, everything's fine again.
You good?
Yep. I'm
right.
good.
Everything's great.
Everything's great.
Just going to keep on rocking and rolling.
Yeah, man. Think positive.
But the point, this is monthly. Last month, there wasn't any industrial production at all.
I feel like you're setting me up.
Well, I try, but you're way too. So there's your yearly. Here's the reality. What you need to be looking at. I mean, that those were real numbers, obviously, but they're bounces. But the point is, they're bounces off of historically just terrible month, and it's a complete restart. Here's what it looks like against last month or against last year.
Yep.
When you're talking about minus 20, minus 14, minus 6.8% in even food, beverage, and tobacco.
And look how uneven it is.
Yeah.
I mean, I think that's the real lesson here is that
computers and electronics are flat.
It's so uneven in its recovery. So that means that if you're hauling, paper, you're doing a little bit better than the petroleum and coal.
Yeah, exactly.
Obviously in the bulk world, but this is going to be prevalent throughout, the freight market here over the next several months. This is going to persist probably for the next year at a minimum.
I would think so.
Yeah,
I would think so. And so let's move on to another one here. So let's talk about maritime here for a second. Because why not? I love talking about maritime. Ships are cool.
Well, maritime, I mean, you were talking about industrial production. That's more of a longer cycle item that you're looking at there. This is more near term. So this is the stuff that we can expect to happen here in the next month or two, have an impact to the freight market in the next month or two. There is a little bit of invisibility between, the boat and getting on the truck, sitting in the warehouse, the transloading, et cetera, which Mike Bowden-Distel has discussed on numerous shows here. How we're seeing a lot of domestic intermodal freight moving right now versus the international containers. So there is a stop off there that we haven't fully identified yet. But this maritime sector is really good to look at in terms of the way I look at it is more like freight potential, near-term freight potential.
Yeah,
if we see
agreed.
If we see a bunch of freight coming into the country, that means the shippers are getting ready for something at some point. It doesn't necessarily mean next week, but it could be here. It's more than likely in the next 6 to 8 weeks.
Yeah, exactly. And so here we go. I got another one pulled up here for you, so we can look at kind of this and see what's moving forward. Okay, so here's Maritime Imports, United States. 2-year, 18-19 versus this year, right? Yep. So we got a seasonality pulled up on it. And I can put on larger fonts here so they can see this a little bit better.
But you can see
what's going on here, right?
This is almost reminiscent of the OTVI that we just looked at. In the way that you see the bounce.
Yep.
In the blue line there, it bounces well underneath previous years.
Yep.
Even though they were both, Chinese New Year's as well. And then
here.
Yeah, and then it recovers really rapidly.
Yep.
And then it bounces again. And you can see it's almost bouncing, we're hovering, but we're bouncing underneath previous years right now.
It is.
And we're kind of every now and again showing up and then back down again.
And then back down again. And here's your latest drop. Oh, imports are up, everybody. Yep. Imports are up. The economy's thriving. No, they just died. Sorry. They just fell out about them right here.
And this is indicative of the fact that we may not be getting the production. We may not be getting the orders.
Yep.
This is, at some point in time, if this number does not come back up and track with those previous years, we can anticipate a substantial decline in volume in freight.
I would think so. This one over here is I'm moving this over so I can get to something else. But I mean, this is durable goods imports starting to fall off again. It did the same bouncing, but it's fallen off again this year. It's not even coming close to last year in 2018. Not even coming close.
And this kind of supports this concept of where we had, really COVID hit at about the optimal time.
Yeah.
For us having as much inventory as possible available in the United States. We saw huge surges in inventory levels prior to January or February, which is traditional. Seasonally
absolutely.
Speaking.
Yeah, no, you do it going into the Chinese New Year. Yeah.
And a lot of this freight has domestic origins, or it's been sitting in the United States for a period of time.
Well, we watched the warehouses drain.
Yeah.
And then we've been watching them fill up. And as you and I have discussed many times on different shows, maybe not discuss, but we've talked about this with the audience and with other people, and we certainly discuss these type of things. When you're looking at the lengths of haul, you can see that it's warehouse repositioning in many cases, because you can see that mid and short haul pick up, right? Yeah. Which will show that. You see the long haul, then the mid haul and short haul. When you start seeing that local and everything pick up and all of them moving at the same time, that's when we have like a stable recovery going on.
Yes, exactly. Right? This is not a stable recovery.
It's not a stable recovery. Here's just really quickly, we just have a minute or so left, but here's the distribution or the inbound imports, U.S. maritime by industry year over year.
Yeah, this is a scary look.
This is a very scary look. You've got to dig into a lot of other things. So we've got a minute. We got a minute left here. I'm going to go back up to this chart up here. I think I am. Yes, I am. I clicked on the right thing. We'll gain some real estate here so everybody can look at this. And so we're looking at outbound tender volumes, right? We're looking at the freight market, and outbound tender volumes isn't everything.
Right.
You've got to look at other things. It depends on where OTRI goes and that type of stuff. So, here, August 15th. Mm-hmm. Where's OTVI at?
Yeah, I think it's potentially right above a 2019 low. I think it's right in the middle of that 2018, 2019, my prediction.
I think it is, or it may even be slightly above 2019.
Okay.
Just because the pull forward may last a little bit longer.
Sure.
I do also think with the unemployment, with the PPP running out, et cetera, the loans on small trucks,
take a minute.
OTRI may actually stay up as this comes down.
Yeah, I think carriers now have hit a point of inflection with OTRI being up now. It's almost like the volumes had to force like the networks to be in balance for the tender rejections to start spiking like they are now.
So we're looking at 10-2.
10-2?
10-2, August 15th.
August 15th?
Somewhere around there.
All right.
Yeah? OTRI still up. That's what I'm thinking.
I feel like OTRI is going to settle back into a 8%.
Okay. I think it's going to stay at 10.
All right.
All right, there you have it, folks. Hey, thanks for watching. Thank you, Zach. Interesting discussion. I just wanted to really talk about that. We're starting to see some industrial numbers and economic numbers that are giving us clearing some of the opaqueness of July 4th and moving forward and kind of seeing what is happening there and what's going on. A ripple effect, a wave, W's that sequentially get smaller as we go, or a reverse square root. I don't know, but we're dropping. We're going to drop off here in the middle of the summer before we bounce back up again. That's what I think.
All signs point to that, but I think there will be probably another bounce too.
Yeah. Oh, yeah. There'll be many bounces. So, hey, thanks for watching, everybody. Peace and love. I'm Michael Vincent. He's Zach Strickland. This is Freight Forecasting. See you every Thursday, 4 p.m. Eastern Time. Peace and love.